Okay, let's continue this lecture. We need to understand that if the credit expense is not matched to the proper period in which the sale was made, the accountant must make an accrual. So we'll get into that later, but you need to be able to show this expense in your sales discounts, your selling expenses, your G&A expenses, general and administrative expenses. So keep in mind that these things must be tracked carefully by the accountant. The accounts receivable ledger, let's understand that there is one separate ledger for each customer, right? If you have, again, I'll use the Macy's credit card account. On Macy's books, if you were to look at their balance sheet, there would be one line for accounts receivable, but understand that there's tens of millions of people, one for every, a ledger for every customer, that all add up to equal that accounts receivable number you see on Macy's balance sheet. All right, so that's the sum of all the individual accounts receivable accounts, and you need to be aware of that. Okay, here's the big deal with credit is if there's bad debt, that means people aren't going to pay you. The owner takes the risk on the bad debt to increase sales, but you must account for the bad debt in the period in which the revenue was recognized. And there's a little bit of an ironic twist here though, because a lot of companies will do the direct method of writing it off. If you don't make any estimation up front, you just wait till the bad debt happens, which is months and months after the sale, and then you just write it off directly. And it looks like this. You just take a bad debt expense, say $45, and you take it out of accounts receivable. So what was once a legal right to collect $45 from somebody, you're now just writing it off and going, yeah, we're never going to get it. So take it out of this asset account, let's expense it, and basically there's no revenue to cover this because you never got the money. Okay, and even though you recognized revenue way back when you sold it, this expense hits months afterwards under this direct method. Okay, if you were to recover it, in other words, the person came forward and said, nope, I'm going to pay you off, you would put it back in accounts receivable, you would accept, you would write off this bad debt expense, you'd reverse it actually, and understand that you wouldn't do any of this unless the person actually gave you cash. So you would have to have cash up front to make sure this got reversed. Okay, and the journal entry I'm not showing you here is that you should have cash and AR here as well. Debit cash $45, credit AR. Okay, this mismatches revenues and expenses. The reason companies can do this is that the amounts usually aren't material. In other words, they aren't big enough. And what I mean by mismatching it is that if you recognize the revenue, say in January of 2012 when you made the sale, you really wouldn't do this write-off step until maybe June of 2012 when you've given up on this person. Therefore, you're recognizing this expense in a very different accounting period than when the revenues first happened. So you got to be careful with that. The direct method only is allowable according to GAAP because it's for small numbers. If you have big numbers that are doing this, then you have to do it differently. You have to use what's called the indirect method. Okay. Under the indirect method, you're going to use allowances. In other words, we'll take an estimate of an expense and we will allow for it. In other words, we'll just take a guess. So what happens here is that you'll guesstimate how much bad debt you're going to have from a whole period worth of sales, and you take an estimate. All right, how you estimate that, we'll get to that in a minute. But basically, you have this, what I call a cushion account. It's called allowance for doubtful accounts. In other words, it's an allowance, it's a cushion, it's an estimate of all the accounts you think might be doubtful. Now, you don't know when you make the sale how many of these you're going to have. You don't know which people it is. But this is a contra asset account. In other words, it appears with the assets. It goes up with a credit. That's why it's a contra account. Most assets go up with a debit. So this is a contra asset account which allows you to take this cushion, this judgment, this allowance to prepare for all the bad debt expenses that are actually going to happen later. Okay? So what happens is when the bad debt actually happens, you write it off in the books completely, but you've already taken the expense up here up front. That's how it works. Okay? So suppose that same customer with $45 never paid us for 6 months. Then we would write it off, and the write-off would look like this. You take it out of accounts receivable with a credit of $45, and you take it out of this cushion account or this allowance account for $45. So I've already taken a $250 credit up here. Now this starts eating away at that to balance it, and I hope I took enough cushion because if I have a whole bunch more of these, it might eat up all of that number there. Okay, that's how this works. Now notice that these numbers aren't the same because this is a judgment of all bad debt that I estimated. This is just one individual customer. Okay, so that's how that works. If the guy did pay, you would actually go do this, reverse this journal entry here. Notice it's exactly reversed. I put it back in accounts receivable. I do put it back in allowance for doubtful accounts, but I would only do that if I got the cash from him. Some would argue, well, debit of accounts receivable and a credit of accounts receivable, don't those cancel? Could I just put cash up here? Yes, you could. Technically it's the same, but most accountants would like to see it done this way with two separate accounts for an audit trail. So this one right here is clearly a reversal of this one up here, and that helps you audit your books a little bit better. Okay, there we go. We'll move on in a second.